Hello, and I'd like to thank everybody for being a part of the session today. And the session is Ways to Pay Off Debt. And I'm Genice DeCorte. I'm with HealthShare Credit Union. And I am going to spend the next 20 minutes or so with you talking about ways that you can look at paying off debt. If anybody has any questions during the session, you can put do the chat portion, and I'll respond to any questions. Okay, but I'm going to go ahead and get started. Um, and thank you for being a part of the presentation. Okay, so the first thing I like to talk about is the um, is the three parts of getting ready to pay off debt. One is gathering information about your financial picture, collecting your data, and then reviewing your spending, your accounts, your history. So the first part is gathering. And what you want to do is you want to get a picture of your finances and what your debt looks like and be honest about it. You want to look at your credit card debts, your mortgages, your auto loans, personal loans. You want to know what the balance is, what the payment is, what the interest rate is, and how long it'll take you to pay those off. Once you get that information, then you want to collect a recent pay stub so you can see what's being deducted from your check and review how much you make every month, how much you take home, and how much is gross. Gross is before your deduction and taxes, and net is your take home. So you want to be able to look at your income to see what you're bringing home every pay period. Then you want to look at your checking account history and review the past 3 months to see where you're spending your money. Most people find that they're spending their money eating out. Of course, in today's environment, that may not be the case, but you may have seen your grocery bill spike, especially if you're caring for your children that are at home now and you're having to feed them 3 times a day when you're not used to that. So you have different areas where you're spending money. And the point of looking at your checking account history for the past 3 months is to figure out where are you spending money and how much you're spending on entertainment, on gas, on food, on groceries, on utilities, and your debts. So once you gather, collect, and review, then what you want to do is analyze your spending and savings. So you want to look at where you're spending money every month. Are there places where you're spending too much money? Could you cut back a little? Once again, before the COVID-19, most people would say that their budget buster is eating out. That's where they spend the most discretionary money from their budget. People always ask me, Janice, should I save money while I'm trying to pay off debt and get out of debt? And my answer is always a resounding yes. And I'll explain why. If you are only taking every dime you make extra and putting it towards debt, that's great. But what can happen is in 2 months down the road, if you need new tires or your car breaks down unexpectedly, or you have a child that needs something, a new pair of shoes or some equipment for a sport that they're playing. Well, if you don't have the cash in a little savings account, then you're going to borrow to pay for those expenses. So I would say yes, definitely try to save money while you're becoming debt free. Make sure that you look at your company's retirement plan. and make sure you're investing the most that you can in that plan, meaning your 401k and your 403b. Make sure that you are with Cone Health, they match 4% up to 8%. So if you contribute 8%, they'll match 4%, 50 cents on the dollar. So if you're only contributing 4% to your 403b with Cone Health, you are leaving free money on the table. So you definitely want to make sure that you're looking at your company's match for the retirement and getting the most free money you can. I tell people I try to keep my car for 10 to 12 years until it starts to cost me more money than a new car would cost. I've got a 2012 Honda CR-V, so it's 8 years old. I haven't put a dime into it. I'll probably keep it another 3, 4, 5 years. Keeping your cars for a while and not having a car payment can help you put some money away and save. Planning meals, ordering groceries online. Now with COVID-19, ordering groceries online is more prevalent than ever. But even before then, it's a great way to budget because you can see exactly what you're spending when you put things in and out of your cart, and you're planning your meals. So you know if you're going to make spaghetti one night, you order the ingredients for spaghetti. Or Taco Tuesday, you order all your taco supplies. So you're planning ahead for your meals. And the sixth thing that I like to talk about is not going overboard on birthdays or holidays. Budget that spending. It's key to being able to get through the holidays without a lot of credit card debt or unexpected expenses. Repayment plan and debt snowball. Dave Ramsey coined the term snowballing your payments, your debt, meaning that he says you want to start with the lowest balance that you have on a credit card and focus on paying that off. And then your second lowest balance, then focus, once you get the first one paid off, you focus on the second one and go through that process until all your debts are paid off. A lot of people get an extra incentive when they can show that they say you have $1,000 credit card. Paying that off gives you that sense of accomplishment. So it really motivates you to keep going and get through your next debt. So you pay as much as you can on the $1,000 till it's paid off. Then you take what you were paying on the 1,000 and apply it to your next lowest credit card debt, and so on until they're all paid off. That's called the snowball plan, where you just snowball the money you're paying into the next debt. I wanted to give these credit card examples because I think they're important. So, if you have a $5,000 credit card at 18%, your payment is 2% of the balance, let's say. It would literally take you 472 months to pay that off. 472 months. So, what you want to do is, and that's 39 years, and you're going to pay about 13,000 in interest over 39 years. That's longer than you have a house because minimum payments go down as your balance goes down. Therefore, it takes you longer to pay them off. Even if you only owed $1,000 on a credit card and you only made the minimum payment, it would take you 151 months to pay that off. Now, 151 months is 12 years to pay off $1,000, and you're going to pay back about $1,400 in interest. That's huge. That's huge. So whatever you bought for that $1,000, say you bought something for $50, you're actually paying over $100 now for it, because that's how long it's going to take you to pay it off. Now, if instead you do a fixed payment, let's say on the $5,000 at 18%, you commit to paying $100 a month until it's paid off. In that case, it will only take you 94 months to pay it off, and you'll pay back $4,300 in interest. Now let's go back. It would have taken you 472 months, $14,000 in interest. Now it's only 94 months and $4,300 in interest. So it's a huge savings just by committing to that $100 a month payment. Now let's say you can pay $150 on that same bill. Instead of 94 months to pay it off, it will only take you 47 months. And you'll pay back only $1,900 in interest versus $4,300. So do you kind of understand, like, just paying an extra $50 a month on the $5,000 debt, you're going to save over half of the interest that you would normally pay if you were just paying the $100. So that's a big amount of money. Then if you take that $1,000 at 18% and the payment's $100, it only takes you 11 months to pay it off. And you're only going to pay back $91 in interest. That's a big difference. 91 versus over here it was 1,400. So committing yourself to an actual fixed payment amount on credit card debt will make a huge difference in the length of time you have that debt and the amount of interest. Now, this is a big one. On mortgages, there is paying extra on your mortgage has a profound effect on how much interest you end up paying overall on the mortgage and how long you have the mortgage. Now, the average price of a home in Greensboro is probably closer to $170,000. So, of course, that means this would be higher, the savings you would have. But I did it based on 120 months. So if you've got a mortgage for 120,000 at 4.25 for 30 years, your payment is $590. Over the 30 years, you're going to pay about $92,000 in interest. So about what you paid for the home, you pay in interest because it's over 30 years. That's a very long time period. Now, if you commit paying an extra $25 a month, which is $615 a month, that shortens it from 30 years to 27 years, and interest, you save over $8,200 for that 30 years. So you've shaved 3 years off and about $8,000 in interest. That's just by paying $25 extra a month. So let's say if we did 50, it increases your payment from $590 to $640, but you shave off 5 years. You go from 30 years to 25, and you save over $15,000 in interest. Now, $15,000 in interest is a lot of money. I mean, think about it. You could buy a nice used car for $15,000. So, and you pay it off 5 years earlier. Now, let's get really ambitious. Your payment's $590, but you commit to paying $690. You will save over $25,000 in interest, and you're going to save about 8 years. So instead of paying it off in 30, you pay it off in just over 22 years. So see how on a big scale, paying a little extra each month can really make a significant difference in how long you have the loan and how much you pay in interest? So the bottom line is By paying extra on your mortgage, you can also get, if you have mortgage insurance on it, because you didn't put the 20% down when you initially financed, by paying extra, you're going to build more equity more quickly in your home. And once you hit 20 or 25% in equity, you can contact your mortgage company to get your mortgage insurance removed. So paying your mortgage down more quickly helps you eliminate PMI faster, which will also save you money. Some people on a $120,000 home, you're probably paying about $70 a month just in mortgage insurance. Now, when you have a mortgage, you do want to make sure that the extra money, the 25, 50, 75 extra 100 a month, is going to principal. Make sure you online, if you make a payment, state that, or if you call, make sure you state that. Also, don't forget, don't leave free money on the table. Contribute the maximum amount into your retirement plan. So, Social Security hopefully will be around for all of us, but you also want to make sure that you've poised yourself to be in a position when you want to retire, you're able to financially. Make sure that you address any pressing financial concerns before you pay extra towards credit cards or mortgage payments. By that, I just mean have a little cushion so that if something comes up, you can afford that car repair or that unexpected bill. I would focus on paying down my credit cards before I put extra on my mortgage. So that's just me. You can make your own decision on that. But your mortgage is probably a lower rate, and at least on a mortgage, you might be getting a tax benefit for the interest that you're paying in a reduction on your taxes at the end of the year. You have to check with obviously a CPA for that. And always PYF, pay yourself first. You want to build a small amount of savings into your budget. And I tell our members, even if you can save $10 a pay period, that's $260 at the end of the year. That can help with a minor car repair. So try to have a separate account where you can pay yourself a small amount every pay period to start saving a little money. The most important thing about getting out of debt is to start today. Today. If you start today, you're one day sooner to being debt free and starting to take charge of your financial freedom. So definitely create a plan, look at your debts, look at your income, and start to find a way to become debt free and pay off debts so that, especially right now during our economic conditions, nobody would have seen this coming. That we wouldn't be able to go get our hair cut or go to, a restaurant and sit down and have dinner with our friends or family. Nobody would have expected that. So we know that the hair salons, the restaurants, the nail salons, they didn't expect to close. And those people didn't expect to lose their jobs in one day. So when you've got control of your finances and your debt, if we run into a situation where all of a sudden financially we're impacted, we are, our spouses or children, then at least we have a stronger um, chance to be able to make it through with a savings account where we've saved some money for the financial downturns. So if you start today, over the years, building strong financial habits, it takes time. And you have to keep reviewing your situation every month and have those conversations with your spouse or significant other because you want to be able to work together in this journey through this process and have support doing so. So I hope that everybody found this information somewhat beneficial. If there's anything you need or questions, you can email me at jenice.decorte@conehealth.com. And I certainly look forward to getting feedback, and hopefully everybody stays safe and well during this unprecedented times that we're in. Well, take care. Thank you so much.